While we're talking about risk management and position sizing and stop loss, and we're talking about the rules for position sizing according to your portfolio for trading stock and for trading options, I wanted to take a moment to address a slightly different aspect of this topic, which is your personal risk tolerance. That personal risk tolerance, we need to really make sure you understand that number, because trading and investing has extremely powerful psychological components to it. And you might recall a previous conversation that we've had. If not, no big deal. I'm going to talk to you a little bit about prospect theory. Now, prospect theory is an award-winning Nobel Prize in Economics award-winning theory by Daniel Kahneman and Amos Tversky that basically helps us understand our natural risk aversion. People are naturally risk averse. You are too. I am. We all are. We don't like unsure gambles, uncertainty. We don't like losing money, and we all have loss aversion. So when it comes to making decisions around our trade management, we need to learn to make those decisions quickly, and we need to make them automatically. Because we have loss aversion and a diminishing sensitivity to the gains, what that means is we feel losses larger than our gains. And it comes down to your reference point, like where you buy the stock, what price you pay. And if I buy the stock or the options, doesn't matter, and I'm making $100, I'm feeling okay. If I'm making $200, I'm feeling pretty good. If I'm making $300, pretty awesome. At a certain point in time, there's a diminishing sensitivity unless you get just a killer, a huge gain. But if you start to feel the losses, if you're down $100, you're going to feel the loss a little bit bigger than when you're up $100. And when you're down $200, you feel that $200 drawdown loss more than you would a $200 gain. And so this is true for most people. And what this creates inside of traders' minds is what I refer to as the internal dragon of chaos that causes you problems. Sometimes traders freeze like a deer in the headlights and fail to exit their trades and end up taking bigger drawdowns than necessary. To avoid that dragon of chaos, you want to predetermine your pain threshold. Now, we talked about account size rules and portfolio design rules, like, hey, don't allocate more than 5 to 10% of your account for stock, 1 to 4% for options. Don't risk more than 1 to 2% of your account, per trade. And you also must address the psychological pain threshold. So I want you to ask yourself, how do you feel if you lose $100? If you had a trade go against you, hit the stop loss, and it ended up being a $100 expense instead of a $100 gain. Well, what if it was $200 and you had a $200 expense or a $200 loss? What about $300? How does that feel? And keep asking yourself this question: $400, $500, $600 drawdown. At what point do you start to feel stress and anxiety and just general discomfort about that dollar loss? And you'll find that number, you'll discover what it is, and it'll make it easier for you to pull the trigger on trades when you know that your trades won't exceed your personal pain threshold. It'll make it easier for you to exit out of trades and feel great about saving money on your portfolio and protecting your capital when you don't exceed that personal pain threshold. Otherwise, what happens to a lot of traders is they get bigger drawdowns, they get frustrated with trading, they end up feeling a lot of stress and anxiety around it. They don't even want to open up their trading accounts and look at the losses. Those types of things happen to people. So psychologically speaking, again, because trading is hugely psychological and it really happens in your head between your ears, you want to make sure you have a really good personal risk tolerance threshold that's well defined, that also matches your portfolio size and the general step trading system rules.